The party is in the last few hours. Volume's going down, the alcohol's being taken away, people are hanging around with a little bit, lights are coming on, they're like, oh, I've been here a little too long. And I think that that's a very healthy process for an economy. These business models were largely unassailable, and they, were really just fighting to grow into their valuation and just generate more revenue to justify where they traded at. And now it's this next phase where they have to operate more like a cash cow business. And so, it's an acknowledgement that the growth is tapering. It's an acknowledgement that they're going to trade on a pretty tight band in terms of multiple, which means that they have to manage expenses much more tightly, which means that they can't have a really broad-based surface area in which to operate an experiment. You have to keep the experiments small. You have to manage your expenses. You can't have employees basically, run over the place. Management has to have a firm hand in dictating strategy and what people work on. So I think all of that signals, I don't think this is the end. I actually think it's the beginning, because these companies, Apple, Facebook, Google, maybe a little bit Microsoft, are the most sensitive to valuation because they are the most widely held, right? These are the equivalent of US treasuries in the equity markets, the safest, most predictable safe haven in times of stress. If you want to own big chunky cash flow generating businesses that are relatively unassailable, you couldn't pick 4 better businesses than those. And so the fact that they see enough in the horizon to say that we need to batten down the hatches should be a warning to everybody else.
Canadian-born billionaire investor Chamath Palihapitiya sees the end of big tech's unprecedented growth, as many of them are now forced to cut back their spending. Make sure to watch till the end, where Chamath reveals where he is investing his money.
So I think we're forming a bottom. We are going to see a hard landing recession. Something will break in 2023. You're going to see unemployment get to an awkward and uncomfortable number. 5-6%, I think, could be something that we see. And I think you're going to see a lot more companies pull way back on their spend because demand is going to really modulate. I'll give you a crazy example. What happens to all the people in the United States that are on ARM mortgages, right? Adjustable rate mortgages. When those things reset, they're going to reset 200-300 basis points higher. Their monthly payments are going to go nuclear. My prediction now is that I think the markets are bottoming and consolidating. This is the time, I think, to start nibbling and start getting ready to really rip the money in. And I think there's enough signals every day that kind of tell me at least that on the margin, it's time, because I think the markets do a reasonably good job of digesting news and then pricing the forward reality, right? Like today's price is really everything we already know. And so the real guess is what's about to happen in the future. And from my perspective, I'm actually starting to get a little constructive. If you think about it one way, the financial markets have always had this thing that we have called a Fed put. What does that mean? A put is essentially the right to sell something. And what market participants have always known for the last decade is that if things got very hairy, if there was uncertainty in the market, the Federal Reserve would, and they have, consistently stepped in to create a buyer of last resort. And so it always eliminated that last part of true, supply-demand balance, because they would just come and say, don't worry. In many ways in tech, what the big tech companies were that. You could never really find what the true market clearing price for an engineer was, or what the true amount of expenses you should spend on office space or, free services. Because you always had these companies, which was an escalating arms race. If one company had a massage, the next company had gyms and massage and physical therapists, and the other company would have buses to take you to the gyms and massage and therapists, and the next company would have protein shakes that were freshly made. And it just kept escalating and escalating because the costs didn't matter. And they wanted, if nothing else, to get that marginal engineer or product manager or business person to work at their company, which eliminated the risk that they would actually start something to disrupt them. So when you take this big tech put out of the market, you will get true price discovery, and you will find out what the real price should be for this kind of an engineer, that kind of a product manager. You'll find out what are the real expenses you need to bear in order to build a real lasting business? And you'll be able to sort through all of that stuff out. So I think it's a really good moment. So I'm constructive. I'm a little bullish. I'll go out on a limb. I think, we could be 3 to 5% from the lows, but we're more near the lows than the highs. In the equity and financial markets, we are consolidating a bottom because we're seeing through to that end state. And this is where cheap equity gets bought. So why is there a reason to sell now? I think a lot of the people that are selling, the smart money sellers that I talk to, are essentially right now selling to book in capital losses to offset other capital gains from this year, a term that's called tax loss harvesting. And so if you have gains through this year, which some of us do, this is the great moment to just sell the losers, to book the loss, to net it out so that you can minimize your taxes for next year. That's probably, I think, where we are at. And I think that's why there's still consolidated buying. And again, it's yet another indication to me that I think, broadly speaking, the markets are now starting to stabilize. All the irrational behavior is starting to exit the system. The party is in the last few hours. Volume's going down, the alcohol's being taken away, people are hanging around with a little bit, lights are coming on, they're like, oh, I've been here a little too long. And I think that that's a very healthy process for an economy. And I think that that's what's happening right now. And by the way, we will also relive what we have empirically known to be true, and it's been pretty well proven. The investments that one makes in this period will probably be the best for many, many years to come because they'll have the most asymmetric upside. And that was true in 2008 and 9 and 10. It was true in 2002, 3 and 4. You're talking incredible companies just in those two periods. Think about this: Atlassian, Tesla,
Uber, Google,
Airbnb, Uber, Instagram, WhatsApp, incredible businesses that have created tremendous value. And so there are businesses that have been invested in for the first time in 2022 and will be invested in for the first time in 2023 and 24, which will be the leading winners of this next phase and this next leg up. And so the real opportunity is to find out who those companies are and get behind them, I think.
Right.
I think the Liz Truss thing is really actually a microcosm of how, unfortunately, Western governments are working, but I think there's a silver lining. Like, she basically came in a day after she got elected and said, okay, guess what, guys? At the same time, I'm going to massively cut taxes and I'm going to give you fiscal stimulus. I'm going to cap your energy bills and I'm going to have these huge transfer payments from the government into the hands of British citizens. But the financial markets, to your point, absolutely hated it. And within a few days, you basically saw the pound get crushed. But then what did you see? You saw the Bank of England decide that financial stability was more important than financial viability, meaning the things that she wanted to do were not viable. So you could have let the financial markets sort this out, which would have forced the prime minister to basically abandon the policy. But instead, the BOE said, no, we're an unlimited buyer of UK gilts, which is the name of the UK bond. And everything snapped back. We're back to where we were before her speech and before the Chancellor of the Exchequer's speech. And so it's as if nothing happened. And that's what's so insane to me, which is that even though the Bank of England, by the way, in the next week or two are going to raise rates 140 basis points, 140 basis points, almost double what the Fed has done the last 3 times. They're doing both at the same time. They're both raising rates and they're acting as a backstop for bad policy. And this is what's wrong right now in the world. We do not have a real check and balance. And so I'm like emotionally on your side. But the problem is, if these folks keep getting bailed out, they're just going to keep doing this stuff and there's no end in sight. I think that the markets are basically ring fencing Russia-Ukraine risk in terms of currency instability, but that's sort of now gone away. We've ring fenced the energy risk because it looks like energy reserves in Europe are actually going to be pretty meaningful. They're going to spend whatever it takes. So all of the second and third order effects, it would be a humanitarian crisis, which would be horrendous, okay? But the markets don't, whether we like it or not, react to humanitarian crises. They react to the second and third order economic impacts of those things. And if you actually try to think about what the second and third order economic impacts are, you're seeing many of those things get solved. And so what it would be a highly isolating effect. It would be a humanitarian atrocity. He would be completely cornered from a worldwide perspective. The monetary and fiscal implications of that may not be as meaningfully disruptive today as they would have been 3 months ago. That's what I'm saying.
Do you think Chamath is right with his take on the market? Let us know in the comments below.